The Reserve Bank has cut interest rates as expected by 25 basis points, taking the cash rate down from 4.1% to 3.85%. This is the second cut in this current cutting cycle, following up from the rate cut in February. Now, if we take a look at what that will mean for mortgage borrowers, you can see that 25 basis point rate cut takes the cash rate down to 3.85%. Of course, we had been sitting at an interest rate high, if you like, of 4.35% ahead of these last two interest rate cuts. This was widely expected. The market had a 99% chance of this priced in. 42 out of 43 economists thought that this would be the outcome. It's really come as no surprise, but probably quite welcome relief for mortgage borrowers. We do have a graphic actually that could show you just how much money you would save if you had a $750,000 mortgage, or in fact, I'll just tell you, based over a 25-year horizon, you would save around $114 per month on that. But of course, when you have a mortgage, you obviously do benefit from an interest rate cut. If you're saving money, it's very likely that the bank will hurriedly pass on that interest rate cut to your savings account, and you will actually be at a disadvantage there. So it sort of cuts both ways, these interest rate decreases, but certainly welcome news for mortgage borrowers. The cash rate coming down from 4.1% to 3.85%. Joining me now is Chief Economist at EY Oceania, Cherelle Murphy. She is in our Canberra studio. Cherelle, no surprises in this move. Does the economy need it, do you think, or is the RBA just trying to get ahead of global developments?
No surprises at all, as you say. I think the economy certainly can justify this, because remember that at 4.1%, the interest rate is actually restricting the economy, and we've got certain parts that are quite soft, so consumption, for example. So we will see from this, I guess, a little bit of an easing up in conditions for households. And of course, on the horizon, potentially there are more risks given what's going on in the global trade environment. So I think when you put those two things together, plus the fact, of course, that inflation has come back down into the target band, both on headline and underlying terms, it certainly does justify this move from the Reserve Bank.
And of course, it is welcomed by home borrowers, but not by savers.
No, that's right. There's, as always with the Reserve Bank's moves, there's some who enjoy it and some who don't. So for those with a mortgage, obviously great news. But if you're relying on savings, then this potentially does take your interest rate down a little bit, and that's clearly a negative for them.
Now, of course, the labour market, as David Taylor was mentioning just a bit earlier, is quite tight. The unemployment rate still at 4.1%. What's the risk here that could spark inflation again?
Certainly when we've got a tight labour market, particularly when it's combined with low productivity growth, you can actually see upside risk to inflation. And this has been on the Reserve Bank's mind for a while, and something that it constantly reminds us of as an upside risk. But we have to say that so far it's not pushing through into inflation. Wages growth is fairly tempered. We've got the wage price index sitting below 3.5% at the moment, which is a fairly low rate, and certainly not inconsistent with its inflation target. Again, the Reserve Bank does tend to be more concerned about that forward view, and so if that strength in the labour market combined with the low productivity growth did actually push up unit labour costs for employers, then the story would be different. But we just haven't seen any evidence of that yet, and I think the Reserve Bank's concerns about that are maybe a little less poignant than they were recently.
I mean, uncertainty is the word of, I guess, this quarter, and the RBA has said in this statement the outlook remains uncertain. Going into this decision, the market was pricing in around 77 basis points of cuts. That's about 3 for this year. How many more interest rate cuts do you see coming?
I think the Reserve Bank potentially has another 2 in it this year, but again, it depends, of course, on how things eventuate. And as we've seen over the last 3 months with the Trump administration, that is very hard to predict. Now, of course, the Reserve Bank makes these decisions month to month. It has no predetermined path for interest rates. But certainly, if we see things calm down, if we see the inflation rate continue to remain in the Reserve Bank's target band, and if we see the economy just putter along at these kind of 2 to 3% rates of growth, then I think it can definitely take a little bit more out of the cash rate to make conditions just that little easier for consumers to potentially lift growth without threatening inflation.
And the RBA statement actually accompanying this it begins on inflation, so that does seem to be a major concern for the RBA. What do you think it's going to be looking for from here?
Well, as we move towards the next meeting, which is not actually until the beginning of July, the Reserve Bank, of course, is going to be looking to see what impact its interest rate cuts to date have had on the economy. It's going to be looking at the labour market very tightly. By July, it won't have the next instalment of the quarterly CPI, so that's not going to probably influence it too much. But of course, the global trading environment, that's really key to what's going on at the moment, not just because of course, of its impacts on exports, but because of its indirect impact on the economy through the nervousness that it's clearly creating in the business environment, and potentially for consumers as well, who may put off some large purchases just till they see things settle down. But, you know, a big combination of factors at the moment, very much global in nature. At the first instance, I think the Reserve Bank's got a lot to think about.
Absolutely. And just a final one, Cherelle Murphy, of course, interest rate cuts are welcome by home borrowers. As you say, the economy could probably do with a little bit more stimulation. What do you make of the economic picture in Australia at the moment?
Look, we've got an economy which is doing okay, not great. Economic growth is soft. It's below potentially where it could be. However, a lot of that is not due to a lack of demand. It's just because the supply side of the economy has been somewhat lacking recently. So we still got a strong labour market. That's to be welcomed, of course. That's a really important driver of growth. But to see a slightly stronger consumer, I think, would be very welcome. Through the first quarter of this year, the consumer was still acting quite conservatively. That discretionary spending was low. So I think the Reserve Bank would be fine with a bit of a pickup there, again, as long as it's not threatening inflation, and we really don't have a lot of evidence that that's the case.
Cherelle Murphy, thank you so much for your insights.